Over the last few years, zero-commission trading and mobile apps have provided widespread access to the financial markets. This accessibility masks a severe behavioral crisis. For many, the rigorous allocation of capital has deteriorated into placing wagers on a brightly lit digital spinning wheel. To see why this is happening, we have to look at the money itself. This chart shows the distribution of financial assets among the 58% of U.S. households that currently participate in the markets. The mean household holdings sits at roughly $557,000, skewed by the wealthiest investors. But the median value is just $53,000. This disparity reveals a dangerous weakness. While the wealthy have robust buffers, the average retail participant has zero margin for error. That limited capital is under heavy pressure from everyday life. By 2019, the median debt-to-income ratio for American debtors hit nearly 96%. A massive portion of household cash flow is locked up in debt servicing, leaving very little disposable income for slow, methodical wealth building. This creates a specific type of market participant, the Ryan archetype. Ryan is digitally fluent and operating under profound macroeconomic anxiety. Facing a reality where traditional wealth building, like buying a home, feels out of reach, Ryan treats the mobile brokerage app as the only accessible ladder for economic mobility. This speculative surge is a calculated, desperate attempt to navigate an environment of persistent inflation and shrinking purchasing power. The user feels trapped by the economy, and the app promises a way out. This divergent line graph illustrates a startling psychological paradox. Across the board, young investors' stated comfort with taking big financial risks has actually dropped. Yet at the same time, 62% of investors under 35 feel they must take major risks just to meet their baseline financial targets. Financial platforms exploit that anxiety using digital engagement practices, or DEPs. These are user interface designs borrowed from the casino gaming industry, engineered to nudge users toward frequent, high-risk actions. The core mechanism is the dopamine loop. When you complete a trade, the screen explodes with digital confetti. When you sign up, you physically mimic scratching off a digital lottery ticket to reveal your free stock. This is variable reward conditioning, the exact same psychological architecture used by slot machines to induce habitual play. Brokerages also weaponize loss aversion. Because humans feel the pain of a financial loss twice as intensely as the pleasure of a gain, gamified platforms implement streak penalties. Users are visually or socially penalized for breaking a daily login or trading streak, creating psychological pain for stopping. The results are measurable. A study by the UK's Financial Conduct Authority found that these behavioral nudges create massive spikes in screen time. On high app depth applications, 21% of users log in more than 50 times per month. These mobile platforms actively rewire the human decision-making process, intentionally blurring the lines between investing, gaming, and gambling. Beyond the screen, the actual wealth extraction happens deep in the market microstructure, specifically within the hyper-leveraged retail options market. In recent years, there has been a massive explosion in 0 days to expiration, or 0 DTE contracts. These are highly volatile option contracts that expire the exact same day they are purchased. Today, 0 DTE contracts account for over half of the daily option volume in the S&P 500, and retail traders drive nearly 50% of that activity. This group is trading complex derivative instruments on borrowed capital without the financial literacy to support it. FINRA testing reveals that 75% of active retail margin traders cannot correctly answer foundational questions about how margin accounts work. They are operating heavy financial machinery without a license. This diagram breaks down a standard retail options trade. Traders preferring cheaper weekly options incur massive structural friction, losing 12.6% of the value to the bid-ask spread. Wholesalers use payment for order flow to exclusively execute and capture that massive spread with zero risk. When you combine a 12.6% spread with the statistical unlikelihood of a weekly option paying out, the expected return is deeply negative. The retail options market operates with the mathematical certainty of a casino, where the house possesses an insurmountable structural edge. This environment creates a dangerous new archetype, the investilator. This is a person who has unknowingly acquired speculative gambling habits while believing they are intelligently building wealth. Surviving the markets is rarely about raw processing power. Sir Isaac Newton lost a fortune during the speculative frenzy of the South Sea bubble. He later observed that he could calculate the motions of the heavenly bodies, but not the madness of the people. Intelligence without emotional discipline invariably leads to disaster. Benjamin Graham, the father of value investing, drew a hard boundary to protect against that madness. He argued that true investing requires 3 rigid conditions: thorough fundamental analysis of a business, the mathematical safety of your principal, and an adequate return over time. Any operation not meeting all 3 is pure speculation. You can see the violation of this boundary in synthetic derivatives like contracts for difference, or CFDs. In a CFD, the participant never acquires the underlying asset. There are no voting rights and no claim on corporate assets. It is a zero-sum wager on short-term price movement. Escaping the investilator trap requires a different perspective. A disciplined purchase of a broad market index fund secures a fractional, legal ownership stake in the entire macroeconomic engine of the country, anchoring your wealth to actual long-term economic productivity. The retail markets have been engineered to monetize human psychology and financial illiteracy. Securing financial independence requires rejecting the anxiety of the crowd, ignoring the behavioral nudges of the app, and realizing that true investing is the slow, disciplined acquisition of economic ownership. You have the ultimate power to walk past the flashing slot machines and quietly acquire the deed to the building.